Tom picks dividend stocks. Mark buys a single index fund. Same amount invested every month, same 30-year horizon, same goal. Tom gets a quarterly check deposited directly into his account and feels like the system is finally working in his favor. Mark watches a number move on a screen and isn't sure if he's doing it right. Tom has screenshots. Mark has patience. And for years, everyone looking at both of their portfolios from the outside would tell you Tom is the one who figured it out. But there is a number hiding inside Tom's strategy that never shows up in his quarterly statement. It doesn't appear in his dividend notifications. It doesn't get mentioned in a single one of the YouTube videos that convinced him to build this portfolio in the first place. And over 30 years, that invisible number quietly takes something from him that he never gets back. When you run the math all the way to the finish line, taxes, fees, return drag, what happens at death, what happens in retirement, the gap between these two strategies is not a rounding error. It is a house. Let's run the math. Tom and Mark are both 32 years old. They both earn $78,000 a year. Same city, same tax bracket, same brokerage platform, same monthly contribution of $1,000. Their only disagreement is how to invest it. Tom builds a dividend portfolio. He researches carefully. He selects a mix of what the finance community calls dividend aristocrats, companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, brands that have raised their dividends for 25 consecutive years or more. He adds SCHD for broad dividend exposure, throws in a couple of REITs to push his yield higher, and includes JEPI for the elevated monthly income it promises. His blended portfolio yields around 4% annually. Every quarter, real money arrives. He reinvests automatically. The whole thing feels active, intelligent, and intentional. Mark opens the same account on the same day and does something that takes about 4 minutes. He buys VOO, Vanguard's S&P 500 ETF, and sets up an automatic monthly purchase. He does not research individual companies. He does not track yield. He does not have a thesis beyond this. The American economy has grown for over a century, and owning a small piece of all of it is probably fine. Then he closes the app and goes back to his life. Tom tells people about his strategy. Mark does not. Nobody at a dinner table has ever said, "Let me walk you through my index fund." There is nothing to walk through. The story tells itself in decades, not conversations. And the story Mark's portfolio is quietly telling, while Tom is busy talking, is one Tom is going to wish he had read earlier. In the first few years, Tom looks right and feels right. By the end of year 2, his portfolio is generating roughly $800 in annual dividends. By year 4, that number has climbed past $2,000. By year 6, he is collecting close to $3,600 a year, nearly $300 a month, without doing a single hour of additional work. The notifications arrive on schedule. The reinvestment happens automatically. The balance keeps climbing. Every signal in front of him says the strategy is working. Mark's VOO position at year 6 is worth approximately $96,000. There are no quarterly deposits. There is no notification that says money arrived, just a balance going up. On every visible scoreboard, Tom is ahead in the thing that feels most real, income. But here is what Tom's quarterly statement does not show him. When a company pays a dividend, the share price drops by exactly the same amount on the ex-dividend date. A stock trading at $80 that pays a $2 dividend opens the next morning at $78. Tom did not receive $2. He moved $2 from one column of his balance sheet to another, and then he owed taxes on it. This is not a fringe opinion. It is settled finance theory, established by economists Miller and Modigliani in 1961 and never seriously challenged since. The dividend did not create value. It redistributed it, and the IRS was waiting on the other side. This is where the real cost starts building, and it builds slowly enough that Tom never notices it in any single year. Every dividend Tom receives is taxable income in the year it is paid, regardless of whether he reinvests every penny, which he does. The IRS does not care that he never spent the money. The moment the dividend hits his account, he owes taxes. Qualified dividends, those paid by US companies held for more than 60 days, are taxed at long-term capital gains rates, 0%, 15%, or 20%, depending on income. For Tom, at his income level, that means 15%. That is the favorable version. But Tom holds rates for yield. Right dividends are not qualified. They are ordinary income, taxed at Tom's marginal rate, the same rate as his paycheck. In 2026, his REIT distributions are taxed at 22%. He also holds JEPI, which generates a portion of its income through options premiums classified as ordinary income. His blended effective tax rate on the full dividend income comes out somewhere between 17% and 20% annually, year after year, for 3 decades. Over 30 years, this annual tax obligation compounds into something enormous. A 0.7% to 1% drag on annual returns sounds like nothing in a single year. On a 30-year compounding window, that drag translates to roughly $280,000 to $330,000 in lost terminal wealth. On Tom's exact contribution schedule, not because he made bad picks, because he got taxed on money he never spent. Mark's VOO generates minimal taxable distributions. S&P 500 index funds do not actively trade. They do not trigger capital gains events. The small dividend VOO does pay around 1.3% annually, is fully qualified. Mark's annual tax drag is somewhere between 0.05% and 0.15%. Compared to Tom's 0.7% to 1%, that difference is quiet, consistent, and relentless. Then there is the sector problem, and it is one Tom built into his strategy without realizing it. Dividend portfolios are structurally weighted toward utilities, consumer staples, financials, and energy. These are mature businesses. They pay dividends because they do not have better uses for the cash. Their growth opportunities are limited. REITs distribute because they are legally required to. The companies that dominate dividend indexes are not the same companies that have driven the majority of US market returns over the past 2 decades. Tom's portfolio does not own Nvidia in any meaningful weight. It barely touches Microsoft, Meta, or Alphabet. His dividend strategy, almost by design, is built around the parts of the market that grow the slowest. VOO owns all of them. Every mega-cap technology company is inside Mark's fund, in proportion to its size. When that sector compounds at 20%, 30%, 40% in a given year, Mark captures it automatically. Tom watches it happen from his consumer staples portfolio. This is not an accident of history. The S&P 500 has returned approximately 10.2% annualized since 1965. Dividend-focused strategies have historically returned closer to 9% over the same horizon. That 1.2% gap does not look like a catastrophe in year 1. Over 30 years of monthly contributions, it is the difference between 2 entirely different retirement outcomes. There is also a behavioral trap inside Tom's strategy that nobody who promotes dividend investing wants to talk about. The dividend check feels like proof. When it arrives, it confirms the strategy is working. Tom sees real money, and real money feels like success. Even when the underlying portfolio is silently underperforming the market it is a subset of. The cash flow creates a psychological smokescreen. Tom can be trailing a simple index fund by 1.5% annually for a decade and never know it, because the quarterly notification keeps arriving on schedule. This is not a minor issue. It is the mechanism by which dividend investors stay inside underperforming strategies longer than they otherwise would. The income signal overrides the return signal. And the return signal is the only one that actually measures whether Tom is building wealth. Let's put numbers on the full 30-year picture, because the cumulative gap is where the story really lives. Year 10. Tom's dividend portfolio sits at approximately $185,000 to $195,000. Mark's VOO position sits at approximately $205,000 to $215,000. The gap at this point is around $20,000. Invisible in terms of Tom's day-to-day experience, because his balance is growing and his dividends are growing with it. Year 20. Tom is at approximately $500,000 to $520,000. Mark is at approximately $615,000 to $635,000. The gap has grown to $115,000. 3 compounding forces have been running simultaneously for 20 years. The return differential between dividend-focused strategies and the full index, the annual tax drag on Tom's distributions, and the fee differential between their funds. Tom's holdings charge between 0.06% and 0.35% in expense ratios. Mark's VOO charges 0.03%. Each of these gaps is small in isolation. Running in the same direction for 240 months, they stop being small. Year 30. Tom's final balance, approximately $1,370,000 to $1,410,000. Mark's final balance, approximately $1,750,000 to $1,810,000. The gap is between $350,000 and $400,000. Tom contributed the exact same amount as Mark, in the same account at the same time, for the same 30 years. He paid more in taxes, he earned a lower underlying return, he paid higher fees, and he never noticed any of those three things happening in any given month because the dividend deposits kept confirming that the machine was running. By year 30, Tom has paid approximately $44,000 to $50,000 in cumulative federal dividend taxes on income he reinvested entirely. Mark has paid roughly $3,000 to $4,000 in taxable distributions over the same period. That $45,000 swing is money that left Tom's compounding engine and went to the IRS. Money that, had it stayed invested at 10%, would have been worth significantly more by retirement. Now here is the piece that almost never gets told, because it requires thinking past the account balance and into the estate. If Mark dies holding VOO and leaves it to his children, his heirs inherit the shares with what the tax code calls a step-up in cost basis. The cost basis resets to the fair market value on the date of death. 30 years of unrealized capital gains, the full appreciation from $1 to whatever the shares are worth, vanishes from a tax perspective. Mark's heirs can sell the entire position the day after he dies and owe zero in federal capital gains tax. Tom has been paying taxes on his portfolio every year of its life. There is no equivalent recovery. The same dollar amount inherited, dramatically different after-tax outcome for the family on the other side of it. Now let's be honest about the real limitations of the index fund approach, because this story only means something if both sides of it are true. Mark cannot live off his portfolio without selling shares. There is no quarterly deposit, no income event, no notification that money arrived. For someone who values the psychological certainty of cash flow in retirement, especially someone in their 70s and 80s, who finds the decision of what to sell and when to be genuinely stressful, that is a real cost. Behavioral costs are real costs. VOO is market cap weighted. The 5 largest positions in the S&P 500 make up a disproportionate share of the index. When mega-cap technology corrects sharply, Mark feels all of it. The index is more concentrated at the top than most people realize, and there is no quality filter. The index owns overvalued companies, struggling companies, and everything in between. Sequence of returns risk is also real. If Mark retires in 2030, and the market immediately drops 35%, he is selling shares at depressed prices to fund his living expenses. That early damage is difficult to fully recover from through compounding. Tom, drawing on his dividends instead of selling shares during a downturn, avoids that forced liquidation. That is a genuine structural advantage. And discipline. Mark needs to stay in his fund through crashes. The S&P 500 fell roughly 34% in 5 weeks in early 2020. Investors who held on rebuilt everything, and then some within 18 months. Investors who sold locked in permanent losses. Tom's dividend income gave him something to hold on to during that period, a tangible reminder that the machine was still running even when the balance said otherwise, that behavioral anchor has real financial value for certain types of investors. These are legitimate advantages. They are just narrower and more conditional than the dividend investing community tends to present them. Here is what the 30-year math actually recommends, because running the numbers to their conclusion should end somewhere practical. During accumulation, the years when the goal is building the largest possible balance, the index fund wins on every mathematical dimension that can be measured. Lower taxes, lower fees, broader diversification, higher historical returns, and full control over when gains are realized. The math is not subtle. The 3 simultaneous drags that cost Tom $350,000 to $400,000 over 30 years are not edge cases. They are the predictable, documented consequences of how dividend investing works in a taxable brokerage account. If Tom wants dividend exposure, the right home for it is inside a Roth IRA. Inside a Roth, the annual tax drag on dividends disappears entirely. The income is never taxed when received. It grows without friction, and qualified withdrawals in retirement come out tax-free. The strategy that costs Tom dearly in a taxable account costs him nothing in a Roth. Placing dividend stocks in a taxable brokerage account when Roth IRA space is available is one of the most expensive placement decisions a retail investor can make. As retirement approaches, within 5 to 10 years of stopping work, gradually adding dividend-focused positions as an income layer alongside the index core is a defensible strategy. Not replacing the index, complementing it. adding cash flow without dismantling the compounding engine that built the wealth in the first place. And in retirement, the tax management advantage of the index fund reverses the income comparison entirely. Mark realizes long-term capital gains when he sells. In 2026, the 0% long-term capital gains bracket covers single filers up to approximately $48,350 in taxable income. By managing his withdrawals carefully, Mark can structure a $50,000 retirement income year at a federal tax rate approaching zero. Tom's dividends arrive on their own schedule. He has no control over when they are realized. His tax bill is fixed by the calendar, not by his planning. Same retirement lifestyle, vastly different tax outcome, and Mark still has $350,000 to $400,000 more in principal, continuing to compound for as long as he lives. Tom did not make a reckless decision. He made a marketed one. The passive income appeal of dividend investing is genuine. The cash flow is real. The companies are often real quality businesses, and the psychological experience of receiving income is something that index investing simply cannot replicate. But the math ran quietly against him for 30 years in ways that never appeared on any quarterly statement. Return drag, tax drag, fee drag, 3 small leaks, all running in the same direction for 360 consecutive months, none of them dramatic in any single month, all of them decisive across 3 decades. Mark did not beat Tom because he was smarter or more disciplined or because he understood something exotic about markets. He beat Tom because he stayed out of the way of his own money. He let the entire economy compound for him, kept his tax footprint as small as possible, and made no decisions that the math didn't support. The passive income that dividend investing promises is real. The cost of that income, in taxes and in the growth it displaces, is also real. Most investors who build dividend portfolios see the first number and never calculate the second. That second number is the one that matters.